And welcome to the Summer's Accountants Tax Toolkit webinar, hosted by me, Paul Davison from PD Tax Consultants. And today we're going to be talking mostly about divorce and demerger, tax on those things. So a lot today about breaking up. There's a little bit of a resume there about myself and the firm. And today I will be ably assisted by my colleague Amy, and please note that these slides do not constitute advice. So a little bit of housekeeping. Your mics won't be enabled at any point, so you can't talk and you won't be seen, but what you can do is send us questions. So as soon as they come into your mind, your head, please send them via the Q&A box to Amy, who will collate all those. We'll be limited to the number of questions we can field, because we're going to be finishing at 10 o'clock on the button. But as soon as you get the question in, the more chance there is for it to be fielded. There's a poll in the middle of the webinar, so get ready for that. And participation in this poll will enter you into a competition to win a free tax sounding board session with myself or Vicky, which is worth £25. If your question isn't answered at the end, please make sure to follow us up on that question. And if you ask a question which is interesting enough, we may well add it to the next Tax Toolkit webinar. So then the nature of these seminars is it's very high level, just trying to give you a feel for the things to think about. So there's a number of tips, hints and pitfalls to get through. I'm going to be therefore as succinct as possible. So because of that, you might not understand all the points to your liking. You might not understand all the points, you might not agree with them all, but what it will do is we'll give you something to think about going forward, and you can follow up on those points as you feel appropriate, either via further reading by yourself, or you can contact us to help you to understand it, which would be great. So moving on now to the first topic, which is tax and divorce. So the first important question, which is quite often overlooked with divorce, is the actual basis of the assets. Who actually owns the assets? What do the facts suggest? Because as we know, tax, capital gains tax, probably the main tax here to think about, is based on beneficial ownership. Who actually has the underlying ownership of that asset? So it's not necessarily whose name is on the land registry. It's not necessarily whose name is on company's house with a share. It's actually who is entitled to the benefit of that property or share or asset, whatever it is. So look at the facts. You know, the facts could include whose name's on the registry, but also could include as who's put that income from a property or from shares onto their tax return form. It could be who's actually had that money to spend. There's a number of factors going on here to think about, and it could be, if there's a lot of property, a lot of assets, then this is actually an exercise in its own right. And there is some case law to consider about this. So the first thing is to work out who actually currently owns the assets as it stands. What we're trying to do really here is you're trying to get a joined up approach with the other side, because what we want to try and do is try to mitigate tax overall between the parties. It doesn't really necessarily matter who saved the tax, but as long as we get the tax down between the parties in total, then there's more net assets to be shared out between the two, which is going to give us a better result overall. And the solicitors can then look to how those tax savings, those net assets can be best saved. So as mentioned before, CGT is probably the main asset to consider, and Normal CGT relief for transfers between spouses continues until the end of the tax year of permanent separation. So if we get the job done in that period, it's much more straightforward. So therefore, the 6th of April is going to be the best day to permanently separate. Obviously, we know it's not as simple as that. And permanently separate is not something we can probably plan or possibly plan. It's not what permanent separation is. It's not divorce. So it's when the two people in the relationship go their separate ways, or could still be living in the same house, but it's when there's no chance of them getting back together as a proper couple. That is the date of permanent separation, and the CGT relief applies in that tax year only. So that's the CGT relief. Interestingly enough, SDLT and stamp duty, which are also important taxes when it comes to divorce, don't follow that same pattern. They are transactions which are in relation to a couple divorcing, separating, or ending their civil partnership, are free from SDLT and stamp duty, no matter when they occur. So often we get complications with couples with property portfolios. So where do we start? We start by analysing the evidence of the underlying beneficial ownership. Whose name is on the land registry, who is paying tax on their tax return forms from the income, who is spending the money that's coming from the property. Do the couples tend to share things 50-50? Once we've nailed that, we know then who owns the assets beneficially, and we can understand their commercial preferences in terms of who's going to end up with which property. Are they going to try and split the properties 50-50 so that one person owns half of the properties outright and one person owns the other half outright? Or is there going to be trying to be some sort of compensation paid in cash or other assets whereby one person ends up with most of the properties and the other person gets cash? Obviously, these things are all to be considered as part of the divorce proceedings, the solicitor. Gains on properties which are jointly owned can be swapped. So if you properties which are jointly owned can be swapped outside of the normal CGT year of exemption, and we can still avoid CGT on those swaps if we meet the conditions of TCJA section 248A. But that's quite a complicated piece of legislation and requires careful consideration, but it could be a very helpful piece of legislation. What happens if the property portfolio is a limited company? How do we deal with that? Well, quite often what we'd possibly like, if we end up taking properties out of the company and moving to somebody else, that's going to give us a lot of tax problems. So one of the things we can try and do is we try and use a demerger such that if that property company is owned 50-50, what we'd like to do is for the existing property company to be owned 100% by one of the spouses, and for, say, half of the properties to be moved to a new co, and for that new co to be owned 100% by the other spouse. That could be done via a demerger, which we have done a couple of times for divorcing couples, and we'll come on to a bit more about that later, demergers later in this session. What happens if you've got a trading business? A trading business tends to be a little bit easier because we can move trading shares easier through gift relief. But we've got an issue that is if one of the couples takes trading shares and the other one takes cash in relation to trading shares, then there could be deemed consideration and the gift relief rules won't apply. If it's a pure gift and one says, well, actually, just to broker this deal, I'm going to give you my half of the shares just to have a quick swap, a quick end to this arrangement, that should qualify. Another way of dealing with a trading company would be that if say one of the spouses is heavily involved in that trading company and the other one isn't, then the spouse that remains in the trading company could buy the other one out. Quite a common route, that, for cash or for a loan payable over a period. And this could be done via a sort of classic NewCo route or purchase of own shares, or depends on the facts. If there's going to be a loan outstanding, it would need to be a NewCo generally, and we're going to need a clearance from HMRC for that transaction, which should be forthcoming because it's a pretty commercial arrangement. Well, it's a commercial reason for the buyout, divorce. Okay, so now on to a poll. If you could think about this for a second, divorce rates are up post-lockdown, but what do you as advisors feel is the most difficult financial part of divorce? Is it A, agreeing valuation? Is it B, trying to get the deal done before the 5th of April? Is it C, interpreting the tax laws? Or is it D, dealing with advisors from opposing party? So I'm going to now relaunch the poll. There's the poll. Please vote. I'm going to play a little bit of music. Thanks very much there for your contribution. The results will be shown on LinkedIn, our YouTube channel, but I can just tell you that the most common answer there was agreeing the valuations was seen to be the most difficult part of a divorce, and I think that's probably what I would have gone for as well. So, from divorce onto the recent mini budget. Just a quick catch up on these couple of things. SDLT on, there's an SDLT on holiday on my own residences bought up to £500,000 prior to 31st of March next year. So that's a big saving for buyers of those houses. But the 3% surcharge will continue to apply in that bracket if you're buying a second home or another home. Up to the 12th of January 2021, VAT on food and non-alcoholic drinks, which is supplied by pubs, restaurants and cafes, and admissions to attractions will be reduced to 5% VAT. And for those accountants out there, the VAT fraction will be 1/21st in terms of working back from the gross. Of course, it's down to the establishment rate to decide whether to reduce their prices to pass on saving. Although I think generally the consensus has been that I've talked to that the VAT saving is probably to help the restaurant, the cafe, to recoup some of the profit that they might have lost through lockdown, etc. And I suppose that's sort of backed up really by the fact that the Eat Out to Help Out scheme saving is only available to the consumer. That's just a very quick brief update on that. Now on to demergers. So those who have looked at demergers will know that a demerger is sort of dividing assets into 2 or 3 or 4. So when is a demerger? What's a demerger and when is it useful? Well, a demerger is useful in 2 types of situations. The first situation is when there's more than one individual owns a company or a group and they fall out. The fallout could be through, as I've mentioned there, divorce, a family feud, quite common, brothers and sisters, mums and dads, etc., or just business partners who fall out. And what we want to try to do really is, if there's more than one business within that group, what we can do is we can say, right, John, you can have that company. Fred, you can have that company. And we're trying to split them so that one person has 100% of one company, the other person has 100% of the other company, rather than having 50% each. The other time we can use a demerger is when a trading company has sort of built up investments over a period. So there's been cash in that company, or it's had bought property for a trade, and all of a sudden that property is no longer used for that trade. It's now investment property. What we can do is we can try and keep the trade, or keep either the trade or the property in the existing company, and move the other asset into a new company owned by the same people. That could be owned by one individual, could be owned by two individuals. But what we're trying to do is move the investments away from the trade. And the reasons for that would be, say, maybe to maintain entrepreneurs relief, or it could be to help with business property relief from IHT, or it could be to facilitate the sale of a business, because you might want to sell the business but keep the property. And the demerger would allow you to do that. What types of businesses can achieve a demerger? Well, these days it could be any type of business, as long as it's a business with a view to make profit. It could be a trading business, or it could be a property business. And the benefit of what we're trying to achieve really is we're trying to split these assets up as best we can in a tax neutral manner. Because when we move in assets from one company to another, there's a lot of different tax charges, potential tax charges on doing that. So we're moving assets, we're issuing shares, distributions, but the tax legislation does have relevant clearances, relevant reliefs within it, which means it may be possible to do it tax neutrally, or at a very low tax cost anyway. But it's important that we do it right to get those reliefs. And we're always going to need a clearance for demerger. That's always going to be part of the case, because the demerger has to be for commercial purpose to make it work. What's very important to understand is that the clearance does not mean the reliefs apply. The clearance means HMRC agree it's for commercial purpose. You as an advisor have to make sure that the reliefs apply and go through it piece by piece to make sure we're doing it right. And then a couple of things here really. Since 2011, it's actually been possible to gain a tax-free uplift in the base cost of tangible assets, tangible capital assets, such as property, through a demerger process such as this, if done correctly. That rule seems too good to be true to a lot of people, but it is right. It's not under debate. And to back that up, more recently, I think it was last year, through a change in legislation by the government, the intangible assets came within the same rules as the tangible assets were before. So the transfer of goodwill in a appropriate manner via a demerger can uplift the goodwill to its current market value without a tax charge. So that is a very good benefit of doing a demerger, but it has to be a side effect of the process, not the reason for the process. So which demerger methods are there? Well, there's three types of demerger methods now. The capital reduction demerger is now probably the most popular because it's the simplest. And it's only really become sort of fully understood over the last 3 or 4 years, because it only came in maybe 10 years ago, the way that the mechanism works. So it's something which has become more understood and is now probably the favoured method of doing a demerger. The section 110 liquidation demerger does still work, but it does require a liquidator, and there are some concerns from people about liquidating companies that don't seem to like it. And obviously it involves the liquidator's fee as well, so the costs tend to be higher for a liquidation demerger. And then there's the statutory demerger method, which is a piece of legislation, but that's very limited and these days hardly ever used. Although it could be used, it would only be a pretty specific situation where you'd use one of those. So with a demerger, we can do things tax neutrally or for a low cost if it's for commercial purpose. But the key is the devil really is in the detail. And if you dabble, you've got to dabble at your peril. And then the final topic for today's seminar is the recent review of the Capital Gains Tax Act as announced by Rishi Sunak on the 14th of July. Obviously, this is quite an interesting development, and commentators believe it's been generated by the lockdown and the effect on the economy, etc., and the need for the government to recoup some tax in the future. Obviously, those who do capital gains tax on a regular basis know there's lots of different reliefs, as mentioned there in the third point, lots of different reliefs, different rates of capital gains tax now, whereas for a number of years, up to 1988, capital gains tax was actually charged at a flat rate of 30%. So, it's amazing how things have changed and how many reliefs have been brought in to try to encourage behaviours or favour different types of investments. And Richie said that the review should identify opportunities relating to admin and technical areas, as well as areas where the present rules can distort behaviour or do not meet policy intent. So it's actually been referred to the Office of Tax Simplification, and their job is to make taxes simple, not to change the rules and to necessarily to gain more tax. But obviously, commentators believe this will be a way of probably increasing the tax rate overall, and looking at potentially taking away reliefs like entrepreneurs relief, possibly bringing in the same rate of tax for shares as we have for residential properties, etc. Who knows? It's pure speculation at the moment. Things like primary residential relief will probably still go probably still exist, because if that went, there'd be an uproar with the public. And there's been no time review put on. There's been no time frame put on this review, so we don't really know when it's going to occur, what's going to happen. So we've really just got to sit by our beds and see what happens. I doubt there'll be anything of a knee-jerk reaction, but who knows? But it has caused some people to think about cashing in assets now, whilst the going is good on entrepreneurs relief, etc. Okay, so that's the end of today's technical content of the seminar. Amy, are you there? And are there any questions to be answered today?
Yeah, got a few questions for you, Paul. So firstly, if a trading company wanted to transfer an investment property into a new company as part of a demerger, would SDLT be payable?
Well, that's a really good question. The answer is it can be done without SDLT being payable. I don't really want to go into the ins and outs of how you would do it, but there's two different mechanisms to avoid SDLT. The first one is transfer to take advantage of group relief. The second one is, was it done as a distribution rather than a transfer? If you get your ducks in a row in terms of how you move the property or how you move the trade, for instance, you might decide to keep the property where it is and move the trade. Therefore, you're not transferring the property, transferring the trade, but that might not be the right answer. So the answer to your question, that question, Amy, is that there are ways you can do it. It just needs to be thought through and advised properly. If anything, SDLT tends to be avoidable, whereas stamp duty tends sometimes to be a problem. Although stamp duty is only at 0.5%, whereas SDLT is at obviously a much higher rate.
Okay,
Thanks,
thank
Amy.
you. Next question, why are capital reduction demergers deemed to be the favourite? Is it because of the tax treatment, or is it more to do with the procedure or professional fees?
Yeah, really good question. On that slide, I mentioned 3 different types of demergers. The third one was a statutory demerger, and actually that statutory demerger can only be done for a trading entity. It can't be done for a property business or an investment business. So that's one of the reasons why you get a statutory demerger. Doesn't really become part of the equation anymore. The capital reduction demerger, I think it's a combination of a few things. As people have understood the legislation, understood it's actually quite a simple task to do the reduction, as long as you obviously check out things like the amount of reserves prior. You need to do some calculations around the amount of reserves, through the process, making sure we can do the reduction. Going through those companies' house rules, the Section 110 demerger was the favourite, but the Section 110 demerger did need a liquidator and did include people having to liquidate companies, which wasn't seen as being a nice thing to do. So it's just come about because A, it's the simplest, and B, it's the most flexible, and C, the fees are going to be lower generally than a Section 110 demerger.
Got time for one more?
Time for one more, I think, Amy. Yeah, just 2 more minutes left. Yep.
So regarding the family home,
Yeah.
if spouse 1 remains in the property and spouse 2 moves out, if spouse 2 transfers their interest to spouse 1, will private residence relief be available in full, and does a specific claim need to be made?
So 2 spouses living in the family home together.
Yeah.
One wants to transfer their half share to the other one.
Yeah, they move out.
They move out,
transfer their interest.
Yeah.
PPR relief be available, and does the claim need to be made?
Yeah, I think that's fairly clear. I think, obviously, you look back at that, the individual who is disposing of their half share, you look back at their history and have they always lived in that property while they've owned it. And if they have, then it's like anybody selling their residence, it should be covered by the principal private residence relief, and it doesn't need to be in the year of separation to avoid CGT. In terms of the claim, any asset which is transferred, which is relieved by the principal private residence relief, doesn't actually need a claim. It doesn't need to go on your tax return form effectively. I've tended to advise clients to put something in the white space about it, just because we know the HMRC look at the land registry documentation and they know who sold the house and when. So if it puts something in the white space about it being fully covered by PPR and the reasons for that, then HMRC can look at the documentation if they want on land registry, but then the answer to that is in the white space of the return, in that no tax is payable. So yeah, thanks for the questions. That's brilliant and good questions there. And I think that concludes today's Accountants Tax Toolkit. It's a beautiful day outside. The sun is shining and the sky is blue. So hopefully we'll have time now to enjoy some of that and have a great rest of the summer. Okay, thank you. Bye.